Now on again. All right, so we're going to try this again, and I apologize for all those who've been waiting for us to get the technology squared away. But this is David Balin, and I want to thank you again for joining us for tonight's presentation, Women and Investing. With me tonight is Rob Zelinger, Divisional Vice President for AIG Financial Distributors. I'm David Balin, and I will act as your host for tonight's program. Rob's presentation will last approximately 30 to 45 minutes and be followed by a question and answer session. To ask a question, click on the chat button on the small Join Me toolbar and type your question anytime during the meeting. The chat button is the one that looks a little bit like a cloud. That is the second one in from the right. On your taskbar. The questions will be saved and addressed during our question and answer session following the presentation. I ask that you keep your questions general in nature, as we will not be able to address individual concerns during this presentation. Rob has 17 years experience in the financial services industry. He works with both advisors and with clients. He lives in the suburbs of Philadelphia with his wife Jody and 2 children. And with that, let me welcome Rob, and thank you for coming to do the presentation this evening.
Dave, thank you. Good evening, everybody. Thanks for joining us. You know, I read somewhere that the average American spends more time planning a single summer vacation than they do planning all of their retirement. So just by clicking on a link tonight, hopefully that puts you guys ahead of the curve. So thank you. So I read recently that 26 out of the 500 companies that comprise the Fortune 500 have CEOs or leaders that are women. That is more than double the number just 20 years ago. So we're making great strides. Our goal tonight, each of you should be viewing yourselves as a CEO of your financial future, and hopefully we'll give you some ammunition and some pointers and tools that'll help you make really good decisions. So here's the good news. Once I get this there we go. So thanks, Dave. We're making great strides. Women control $18.4 trillion of consumer spending. And this one kind of blew me away a little bit. Women comprise 2/3 of the current U.S. workforce, and nearly 40% of women out-earn their husbands. However, there are really some unique challenges that face women when it comes to their financial future. You know, traditionally, women were the caregivers. The difference now is many of you are both the primary caregivers in your family, but also the primary breadwinner in your family. And that causes some unique challenges. You may be in a situation where not only are you caring for children, but you've got aging or elderly parents that you're caring for at the same time. Puts a lot of, obviously, emotional and physical stress, but you combine that, if you're a primary breadwinner, with the financial stress of doing that. It proves to be some unique challenges that maybe historically men have not faced. So we're going to try to address a lot of these. We can't address every challenge you face, but we're going to focus on 5 over the next few minutes that'll hopefully put you in a good position to make sure that you are the CEO that you want to be of your personal finances. Challenge number 1, lower earnings and by default, lower retirement savings. Women earn 70 cents on the dollar for every dollar that a man earns, looking at people that are employed full-time. Obviously, that hurts income. But where it really hurts in terms of long-term financial planning is it means that women contribute 30% less to retirement plans than do men. Now, interestingly enough, savings rates are pretty similar. Women save at about 6.7% of income. Men save about 7.2% of income, so that's not too far off. But you're talking about 6.7% of 70 cents on the dollar. It means you're saving 30% less. So the average retirement savings for women right now, $108,000 at retirement, compared to an average of $149,000 for men. Pretty significant differences. So strategy number 1, in order to combat that, is how do you maximize your IRAs and 401k plans? 3 things that I think will help us get there, and I'll get into these in a little bit more detail. Number 1, take advantage of the long-term compounding effects and benefits of tax deferral. Number 2, the advantages of pre-tax contributions and the ability to save more without really dramatically affecting your take-home pay. And number three, company matches. Let me sort of delve into each of those in a little more detail. So this is not hyperbole, but by cutting down on a latte a day could result in an extra $141,000 in savings. So how we come to that number? Average cost of a latte, call it $5. You do $5 a day every day. It's $155 a month. Over the course of a year, that's $1,860 you're saving every year. If you took that $1,860, invested it, or tax deferred, 25 years, with an average return of 8%, dramatic, just pretty reasonable, I think, $141,800 would be the balance. So I'm not telling you not to drink coffee. I don't think I could survive without it. But just an extra $5 a day. And the reason why that grows so much is it's compounding returns. It's not paying taxes every year. By the way, if you did the same thing and just saved the money in a non-tax deferred vehicle, you'd still have $101,000, which isn't too bad either. But with the power of tax deferral, it's an extra $41,800, a part of your retirement savings. So number one, take advantage of and try to maximize what you can put away from a tax deferred standpoint. It's not yet April 15th, so it's not too late to make those contributions for this year's returns. Second thing is, of course, the ability to use pre-tax savings. So let's look at this example real quick. I found this one fascinating. So we've got two hypothetical people, Mary and Jane. They both have $155,000 in income. They're both married, filing jointly. Mary saves $6,200 a year, or in other words, she's putting away 4% of her salary. So this is pre-tax going into 401k. That means her taxable income is $148,000, which puts her in the 28% tax bracket. Her net after-tax income, $107,000. Jane, same job, works at the same company, makes the same income. She put away the current maximum allowable amount, $17,500. It's about 11.3% of her salary. Her taxable income is $137,500. Therefore, she's in the 25% tax bracket. Net after-tax income for Jane, $103,125. So even though Jane is saving significantly more money, their net after-tax income is almost the same. In other words, their take-home pay is not that much different. Now let's look at what that means over the long term. If they continue that trend for 25 years, Jane ends up with a balance of $1.3 million versus $489,000 for Mary. Due to the power of tax compounding, she earned, this is just earnings, growing tax deferred inside of her 401k, she earned an extra $587,000 over that 25-year period. And let's go back to the beginning. She did all that, and if you look at her take-home pay, it's really almost the same as Mary's. So putting money away pre-tax, your take-home pay is not reduced significantly versus someone who wasn't making the maximum contribution, but your savings at the end of 25 years, that's a huge difference. So point number two in maximizing IRAs, take advantage of pre-tax contributions. Also, always take advantage of free money. Now, before Donald Trump was famous for firing people or having nice hair, when he was still in the real estate business and actually good at it, you know, his probably most famous business tactic, if you ever saw his first book, The Art of the Deal, is spend other people's money, use other people's money. That's how he financed most of those initial real estate deals in New York. Same thing when it comes to your savings. If you work for a company that has a match in their 401k, take advantage of it. It's free money. It's not yours, but you get to keep it when you retire, and you're growing those dollars on a tax deferred basis. You know, we use the same example from the previous page and compared a matching to a non-matching retirement plan, and the difference over 25 years is $734,000. That's with a 6% match, and someone that was contributing to max $17,500. So if you've got a plan available to you and they have a match, you certainly want to take advantage of it as much as possible. So what we want to do there is maximize our savings. Now, challenge number 2, rising retirement costs. Women on average tend to have higher retirement expenses than men. Healthcare expenses alone for women are $417,000 compared to $369,000 for men. And there's a couple reasons. Why. Number one, and I think we all know this to be the case, women live longer. Women live at least 5 years longer on average, and they spend significantly more money on healthcare costs and long-term care services. So inflation is a factor for everybody in retirement, and being able to make sure services you need even as those costs rise over time. But for women, because they tend to live longer and because they tend to have more health care costs, especially later in retirement, it's even more important to make sure that you are addressing those things. So strategy number 2 that we're going to talk about and addressing this challenge is making sure that your portfolio has growth potential. So if you look at this chart, we compare the 3 most common investment classes: stocks, bonds, and cash. And we're looking out over a relatively long period of time. So the yellow bar is significant. Stocks have obviously averaged more than bonds, and bonds have averaged obviously a lot more than cash. What really matters here is that blue bar. That's your real return. Real return identified as what you earn after taxes and after inflation, because this is what really matters over a long period of time. Stocks are the only asset here that have kept up with and beaten real return when you factor into account taxes and inflation. 4.7% historically for stocks. You're flat basically with bonds at 0.7. And if you keep your money in cash, while it is safe, when you factor in inflation and you factor in taxes, you're basically losing money over time. Now, we are in a low inflationary market environment right now, which is a good thing from that standpoint. However, we're also in historically low interest rate environment, so you're not earning that much money either at the same time. Make sure that you use the power of long-term growth in equities to help make sure you compensate for and keep up with inflation and taxes over a long period of time. Now, the reality is we know that investing in stocks carries risk. It's why if you work with someone like Dave that can help you create a diversified portfolio and manage that money on a daily basis, it's certainly a benefit. But keep something in mind. It's long term. Investments are designed to work. I think this is a Warren Buffett quote. Investments were designed to work over time, not every time. But if you look at this chart, and I thought this was kind of interesting. So we take rolling periods dating back to 1926. For every rolling 1-year period that we could look at, 72% of the time you receive positive returns in the market. In this case, the market's identified by the S&P 500 index. 28% of the time you had a loss. And yes, some of those losses were pretty significant. 2008 is still fresh in a lot of people's mind. If you extend that and look at 5-year periods, though, we cut the number of losses in half. So 86% of the time you had a gain, only 14% of the time you had a loss. When you extend that out to 10-year rolling periods, it's down to only 5% of the time they experience a loss. And for as long as we can go, for every 15-year period of time, there's never been a loss investing in the market. So the point is, let's not get scared by the volatility of the market, although it is something that's a significant factor. But by working with someone, have a diversified portfolio, and keeping in mind the long term, you can help fight the risk of inflation and compensating for the growth that you need for a long-term retirement. So challenge number 3 is that many women have inadequate or substantially less income than men when it comes to retirement. For women and men, and we looked at people aged 65 and older, on average, women were earning or had median income 25% lower than those of men. This is even though, if you remember a couple slides ago, women needed more retirement income. Their median income on average 65 is actually 25% lower than that of men. And there's a couple factors here that go into it. Part of it is women spent more time away caring for children and caring for parents, which obviously affected income. And the other part of it is women were not taking advantage of or did not have as much Social Security income, which is a key and huge component of this. So strategy number 3 is take full advantage of Social Security benefits. So we're going to talk about a few strategies and some things along the lines of Social Security here. Well, we could probably spend an hour just going over Social Security strategy. Here's a few basics. If your full retirement age was age 66 and your benefit at full retirement age was $1,000 per month, if you take Social Security early, and you can begin taking Social Security benefit, however it is reduced, you're looking at a $750 a month benefit, so a 25% reduction. However, you don't even have to take Social Security at full retirement age. If yours was 66, you can delay your Social Security out as long as age 70. If you do that, your Social Security benefit is going to go up every year, as much as 8% per year. So at age 70, that same individual would have a monthly benefit of $13,200. So the difference between someone taking their income at 62 and taking it at 70, 750 versus 1320 in this example, that's a difference of 76%. That is significant. Right now, the average age at which people elect to take their Social Security benefit in this country is 63. And the reason is they can't. You get close to retirement age, you know it's there, people turn it on. It doesn't always make the most financial sense to do so. If you have enough personal savings that you don't need to turn on Social Security. And this is true whether you continue to work, but if you have other resources that can create a bridge, it's sometimes taking Social Security all the way out to age 70. And I don't want to sort of go off on too big an aside here, but one of the comments that I hear quite a bit, especially when we do Social Security workshops, is I won't live long enough to make up the difference. I want to get the money in my pocket now, or say, yes, Rob, but I got $750 at 62. I didn't get anything till age 70. I want that money now. The crossover point, where delaying would give you as much income as if you had taken early, the crossover point is somewhere between age 78 and age 81. Now, if we look at life expectancy, that's really not that far down the road. So it's something to think about in terms of maximizing your retirement income. Now, a couple things. Make sure you're taking advantage of the spousal benefit. Spousal benefit means you get or are able to elect the greater of your own benefit or 50% of your husband's benefit. So if your benefit is $1,000 a month at full retirement age, your husband's benefit's $2,400 a month at full retirement age, you can get 50% of that. That's $1,200. That's a 20% pay raise right there by taking advantage of the spousal benefits as opposed to taking your own benefit. Now, one of the strategies there you can think about doing is you can take the spousal benefit, let your own benefit grow, and then switch back over to your own benefit at age 70. Now, I'm going to go through this example as a way to maximize income. This is something called the phase-in strategy. You're probably not going to be able to walk into the Social Security office and say, hey, I want to do this phase-in strategy, and they're going to map it all out for you. But just sort of understanding these basic concepts, which is this. If you take a benefit prior to full retirement age, your benefit's reduced. If you take benefit after full retirement age, it's greater. So the strategy here is simply this. If you're a married couple and you're going to take one benefit early, take the lower benefit early, because if it's reduced on a percentage basis, it's not as large a dollar difference. And if you're going to let one of two numbers grow, let the larger number grow. You'd rather get 8% a year growth on the larger number than a smaller number. But if we combine those together, we can maximize Social Security. Dave has a heck of a lot of experience going through these scenarios, including calculators that allow him to design these strategies for clients. But here's just an example. You've got a married couple. They're full retirement age 66. We'll say the wife in this example has a $1,000 benefit. The husband has a $2,400 benefit at full retirement age. They're currently 62 years old. Instead of them both taking it at 62, here's what they're going to do. The spouse is going to take the benefit early. So that $1,000 a month benefit is reduced. She's getting $750 a month. At age 66, full retirement age, the husband does not elect his own benefit, but elects the spousal benefit, which is 50% of her benefit at full retirement age. So he's going to get $500 a month. Wife is going to continue to get $750 a month. Now their total benefit is $1,250. Now they get to age 70. Now at age 70, the husband's going, because you can't delay it anymore, the husband's going to switch over to his own benefit. Now, his benefit, which was $2,400 a month at full retirement, has now grown to $3,168. The spouse is now eligible for the spousal benefit because the husband filed. And her up to $950 a month. Their combined income $4,100 a month at age 70. If they both live to age 90, total benefits paid $1.1 million. That's $215,000 more than had they both just filed for benefits at age 62. That is a pretty significant difference, in my opinion, simply by understanding and knowing how to take advantage of and maximize your Social Security benefits. I think it's one of the advantages of working with a financial advisor. The folks at the Social Security Administration do a great job. They're not in the business of giving advice. They're in the business of giving answers. You have to know the right questions to ask, and that's one thing that that Dave can certainly help you with. So make sure you're maximizing your Social Security benefits. The fourth challenge that women face is longevity, just living a really long time. Women outlive men by an average of 5 years. Women are also 4 times more likely to be widowed than men. One of the ways to address that is make sure that you have enough sources of, not just sources of income, but sources of lifetime income or guaranteed lifetime income. So if you look at most folks, retirement is sort of traditionally some sort of a three-legged stool. Your sources of guaranteed income are Social Security, and if you're lucky, a pension. The rest of your income comes from continuing to work or income from your assets and your savings. So, your guaranteed source of income, according to this, represent much less than half of your overall income. So a strategy would be if we can reposition some of our assets and savings into vehicles that are going to be able to provide an income for life. The most common way to do that is to use some form of an annuity. There are fixed annuities, there are indexed annuities, there are variable annuities. All annuities have the ability, through something called annuitization, to provide a guaranteed lifetime income. Also, many of these products today can provide an income stream that's guaranteed for life or guaranteed for both lives if you're married without having to lose control of the asset through annuitization. There's literally and probably an endless amount of choices when it comes to the types of lifetime income products that are out there. Dave's been doing this for a really long time, and he's probably seen just about everything. And in terms of positioning part of your assets into something that provides lifetime income, Dave has done the research already to sort of help figure out which makes the most sense in which situations. So think about repositioning some of your savings into when you hit retirement, into vehicles that can provide a lifetime income. Now the fifth challenge is the challenge we don't know about. The fifth challenge is, of course, the unexpected. Planning for that with which we don't entirely know what's going to happen. But there are significant life events like divorce and being widowed, et cetera, have significant impacts. A woman's household income, on average, fell by 41% after divorce and 37% after the loss of a spouse, compared to a decline of only 23% and 22% respectively for men. So make sure that you have adequate insurance and emergency funds to put yourself in a position not to suffer financially if any of these things happen. So obviously, life insurance is excellent protection where appropriate in terms of protecting yourself in the case of a loss of a spouse. Also, particularly for women, taking advantage of long-term care insurance where it's appropriate, where it's affordable, where it is feasible. And women tend to spend a lot more money on long-term care insurance, or long-term care, I should say, than men do, because they tend to live a lot longer and stay longer at long-term care facilities. And having an emergency fund is never a bad idea. It's recommended that somewhere up to 3 to 6 months of living expenses be put in something safe or cash, so it's there in case of emergency or in case of an accident or something like that. So let's go back to Social Security for a second as it relates to this. So if you get divorced and you have not yet remarried, you are still eligible for your spousal benefit. You don't need to have any contact with the ex-spouse. You're just automatically eligible. The key is if you have to be married for at least 10 years and not be remarried. It's interesting, and we see this more in Florida than anywhere else, and you certainly see this in retirement communities. The decision to remarry after divorce is sometimes predicated on financial matters, and keep that in mind if you are eligible for significant Social Security benefits. If you get remarried and your new spouse doesn't have as much, not nearly as high a Social Security benefit, it could actually hurt you financially. But it's kind of interesting that people make more than anything else. Also, survivor benefits. If you have a spouse that passes away, you don't continue to get 2 Social Security checks. You're down to 1 Social Security check. However, you get the greater of the 2 Social Security checks. So if you had a benefit of $1,000 a month, husband had a benefit of $2,400 a month, the husband passes away, you're going to lose one of those 2 checks. So obviously you drop the $1,000 check, you take advantage of the survivor benefit, and you step up to that $2,400 a month benefit. But you want to make sure that you take advantage of it. It doesn't help you if you don't know enough to go to the Social Security Administration office or get online and make sure that you take advantage of that. If you take the survivor benefit early, just like your regular benefit, it's reduced if you take it prior to full retirement age. Something else to keep in mind when it comes to divorce, there's something called a quadro. Some of you may have heard of this, but a quadro is a legal court order that allows you to get your ex-spouse's retirement benefits or your share of retirement benefits. This is typically negotiated in the divorce process. But whether it's a defined contribution plan like a 401k or an IRA where you're getting half of the assets, or it's an actual traditional pension where you're getting half of the benefit, you need that quadro document in order to do that. But just make sure you're taking advantage of that so you don't suffer a loss of income as a result of divorce. So just to sort of circle back and take a look at these things, in order to do as efficient and adequate a job as you can in terms of being, as I said in the beginning, the CEO of your financial future, number one, make sure that you are maximizing your IRAs and 401k plans. Because not only are you reducing current taxes, you're growing the pot substantially more by doing so. Make sure that your portfolio is positioned for growth. It is possible to be too conservative. And by being too conservative, when you factor in inflation and taxes, you're actually taking on a heck of a lot more risk than you would be with a portfolio that's positioned more towards growth. Number three, you paid into Social Security your whole life, or your whole working life. So has your spouse, if you're married. Make sure you take full advantage and you get every penny you can out of Social Security. It's one of the few sources, if not only source for a lot of folks, of true guaranteed lifetime income. Number four, create a pension for yourself. Where appropriate, convert some of those savings into vehicles that can provide a steady, predictable stream of income that will last as long as you do. And number five, prepare for the unexpected. whether that be through savings, whether that be through insurance, or a combination of the two. The more planning you do to make sure you're protected in the case of something that's unexpected, the greater your potential will be in order to make sure that your income in retirement is not affected as a result of that. That being said, appreciate everyone that tuned in. I want to turn it back over to Dave for questions and hopefully some answers.
Rob, thank you very much. That was an excellent presentation. I know I took a lot of notes here, and I appreciate everyone sticking with us. I heard that the sound quality did not measure up tonight, that we had a couple times where we lost a signal, but I hope everyone got enough out of this when the sound was on, which is, I know, the majority of the time. We're now going to open up to questions. And to ask a question, again, what you're going to do is press on the chat button, which is the second one to from the left. It looks like a little cloud-shaped cartoons. Just click on that chat button and type in your question. I ask that you keep your questions general in nature. Again, we won't be able to address any individual concerns. And while we're waiting for the first question to come in, I'm going to just take advantage of the opportunity to ask the first one myself. Rob, you had mentioned two trends I want to combine here. One is that women live longer, so we have the longevity issue. The second one that you talked about is that women spend more on healthcare in retirement, which to me sounds like a double whammy. If you're going to spend more each year for healthcare, you live longer doing it, you're going to spend a lot more than men. And I know you gave the statistic during the presentation. My question to you is, how does a woman prepare for retirement and those types of expenses differently than a man would, or how does a married couple? Because as we're talking about women and investing, that incorporates every married couple as well.
Yeah, good question. Dealing with, well, particularly with a married couple, what happens quite a bit is if there was a spouse that was the primary wage earner and maybe a spouse that was stay-at-home part-time and did not have as much savings, you have to look at at those IRAs as combined as one asset, and don't just invest the money based on on one spouse's investment risk tolerance and their time frame, but look at it as a whole. For example, male life expectancy is age 78, but a married couple age 65, it's about a 30-year life expectancy. There's about a 50% chance that one of them will live into their mid-90s. Most likely the woman or the female. So you have to keep that in mind. So any of these investment strategies we talked about, whether it be investing long-term for growth, or whether it be converting some assets into some sort of lifetime income product, make sure it's designed to cover or take advantage of the fact that that one of those spouses, most likely the woman, is going to live significantly longer than the other spouse.
Okay, great. See, we have our first question coming in. The question says that since women are living longer now, do you see a difference in the way that women invest for retirement than they have in the past?
Well, for one thing, and this has probably been a trend that's been going on for quite some time, women are probably more empowered, and B, a heck of a lot more knowledgeable than maybe they were about investing, just 20 or 30 years ago. When I first got into business, about 17 years ago, oftentimes you sit down with a couple planning for retirement, and the husband seemed like the one making the decisions. That's clearly changing. Women need to be active in that conversation throughout the entire process, because what happens otherwise? Husband passes away first. The surviving spouse has never invested in his or her life, and she's either trying to do it on her own, or she's working with a financial advisor that she hadn't met with, because the husband, he takes care of all that stuff. So I think one of the primary differences that we've seen is women are much more involved in the decision-making process. But also, we're looking at it at a much longer period of time. So you retire from a company that offers a pension. There might be a single life option, and there might be a reduced payout, but a joint life option. if the husband's making that decision on his own, he might take the single life option because it's more income for him while he's alive. If that decision is being made as a couple, it may make more sense to take a little bit less income to know that that pension or that income option is for both lives. So it's being more involved is the biggest change that I've seen.
Great. I love the quote that you gave, the Warren Buffett quote, where investments are designed to work overtime and not every time. Along those lines, I know when I've worked with clients, we've seen a shifting, I believe, in the public's opinion of investing now, where they're looking as much today to protect what they already have as they are to get long-term growth. And yet we know that if you're too conservative in the way you invest your money, you won't be able to accomplish all the goals that you have set up. So with that in mind, how does a person protect what they already have and yet still have a growth opportunity in their portfolio?
Well, there's this sort of old adage that it's not what you make. So we certainly have seen a trend from an investing standpoint of looking at what we'll call risk managed sorts of investments and strategies. However, I think there's a way to take advantage of protection strategies that can help make sure you do that. Insurance companies, in particular, do give you the ability to invest money in the market with growth, and typically there's going to be higher fees, but use an investment product that has some guarantees associated with it, like an annuity that allows you to keep the money invested, like perhaps you would with a mutual fund portfolio, but still you're transferring some of that risk for additional cost, of course, in order to get some sort of guaranteed lifetime income strategy, so that you're protected on the downside in terms of having income that you can't outlive, but you still have the ability over a long period of time to take advantage of long-term growth in the market.
I know some of the most attractive products that we've seen in recent times are these contracts that guarantee an income stream, say starting at 65, if that's when you choose to get the ball rolling, but also that income stream goes up. So as there's inflation and as your expenses might go up in retirement, so goes that income stream. And in the past, that wasn't the case. Everything got locked in and didn't give the growth potential. And your company in particular has a very attractive product along those lines. I guess I'll throw it open to you for any final thoughts that you have about the subject. I think it's fascinating that with more than half the populace being represented by women and women controlling more and more assets over time, this has been a topic that really has not been presented in many public forums. I just want to just get your impression on why you think that is, and do you see this as a trend going forward?
It definitely is. I know that a few folks I work with just recently actually were at a women investing conference that was driven by female financial advisors and female investors. I think it was just an inevitable progression. We saw the statistic early in the presentation. 2/3 of the workforce are women. From an investing standpoint, let's face it, I think Wall Street probably historically has been, if not dominated, but predominantly a male-driven industry. That's changing quite a bit, and what does that mean? It means we're catering to the audience. Like any business, you have to adapt to the consumer, and you have to adapt to the customer. If the customer is more than 50% female or 50% women, then certainly the solutions and the strategies that are being presented by financial institutions, by financial companies, by investment firms, by insurance companies have to be able to address the growing needs of women, and that trend's going to continue.
Well, thank you very much for what I think has been a real informative presentation. I always appreciate your efforts on our behalf, and this is a great way to share you with all of our clients at once. Thank you again for coming in, and I look forward to the next time that we can have you as a guest.
Anytime. Thank you.